Welcome to TMS Insights. It's May 2024. It's been a busy time for the share market, Ben. Reporting season typically February and August, but not every company has a year end neatly 30 June or 31 December. So there are companies that give us some updates at these times. Amongst those are things like we hear from ResMed on a quarterly basis.
Yep.
Our banks have just reported.
Three of the four banks.
We hear from Aristocrat, Xero, also Macquarie, another bank.
Yep.
So we're going to talk about those stocks today, and we're going to talk about some of the activity been going on. Maybe a really big one that broke overnight was the third bid from BHP for Anglo American, trying to get base metals, in particular copper, into further exposure in their portfolio, has been withdrawn after the board of Anglo rejected that one, didn't want to entertain a discussion about how that might look. Just pretty big scale bid
Huge
stuff, mate. Yeah.
It would have been the biggest transaction in Australian corporate history, and it would have significantly changed index weighting and stuff like that on our market, making BHP even more concentrated in the index. So, look, it's hard to know whether they were paying a big price. It seems amazing Anglo weren't willing to engage.
Yeah. And interestingly, after the second bid, Anglo came out with a plan to do pretty much what BHP wanted, to split up the assets. But BHP was going to take on some of that execution risk of selling those assets. In many ways, we see these play out better if the divestments have happened first.
Completely. And also, from what you read, we don't, I think, follow it too closely, but Anglo has had a lot of production issues in some of its bigger mines across the world. So you're sort of backing the BHP management that they were going to turn that around, which is maybe then it made sense for the price that they were paying. You can forget, I think our miners are, like Australia, are world-class at mining. You can forget, it's just seamless. It seems we get very little production issues from the big players here.
Yeah, it's interesting. We do these days, but over time it's been different.
Yeah,
you're right. So ASX is 12% BHP. So that could have been bigger. Interestingly, BHP was sold off after that first bid. It's recovered as it looked unlikely that they would get Anglo.
Yeah.
So quite an interesting one. So we'll park that one. We're obviously just reminding clients how interested we remain in copper as a base metal, both for the green revolution and for its centuries-old industrial uses.
And I think increasingly, when you read around 2.5% of the world's electricity production is currently used by data centres, and that's going to be another structural growth engine because there's going to be a lot of copper that's needed to work out how to power all these data centres that are about to be built over the next decade.
So the theme's not going away, that's for sure. Getting into some of those results we mentioned, ResMed's been one of the most talked about stocks in the last year. It's had the most incredible run and sell-off last year and recovery. And the numbers they're producing remain very solid, Ben.
Yeah, look, it's certainly given us a lot of headaches, and probably last year it was a stock that we were really having to get our head around Ozempic and what it could mean for the sleep apnea business. I think the management's done as good a job as it could have at helping the market understand what the impacts of Ozempic is. I would say Eli Lilly has come out with a clinical trial about 6 weeks ago in Europe, which looked at OSA versus Ozempic, and that trial was successful. But what we are also seeing from ResMed's point of view is that as patients are presenting to get Ozempic, the doctor is saying you probably have sleep apnea and you should also consider approaching that with a ResMed mask. But the big highlight of this result was the margin improvement, which was back to where we saw before a lot of the production issues that ResMed experienced during COVID. And, the business continues to grow. It's probably not one you buy now because it has had a really good recovery. And I think there is still a bit of risk on the outlook, but it's continuing to shrug those off.
It's still trading well below its long-term PE multiples.
It is.
But it might. And I think that's the point.
That's true.
Things have probably changed. But, the main fact there is Philips, their largest competitor, hasn't made a recovery back into the market.
It hasn't, and that's been a tailwind for ResMed, and that's not looking like it's getting any time closer. and this other big thing that ResMed had the problem was they had at one stage nearly a year wait to get the new AirSense 11. So they were selling the previous model at a knockdown price just to get those patients, as they called it, in the ResMed ecosystem.
Yeah,
squash margins. Analysts thought that might have been an Ozempic
ongoing issue,
but
but it wasn't.
Look like it is.
No, that's good. While we're on that one, let's go to stay healthcare. Talk Fisher and Paykel Healthcare, humidifiers and a number of other products. Another really great result from them. They got sold off last year a bit. Nothing related really, but
no, I think there wasn't it's always hard to know. I think there wasn't a bit of an Ozempic thing in there, but this business, as with a lot of businesses, experienced a crazy ride through COVID. There was this boom in sales, then there was the big drop off in sales because everyone had over-ordered because of COVID, and what the CEO called out was a return to the long. He sort of said that the ordering that they're seeing from their hospitals, etc., has returned to the long-term historical
pre-COVID rates
and normal levels of ordering. Big margin improvement as well. So they called out a 65% profit margin, sales margin by FY27, which was massive. A surprise. And
any business would love a margin like that.
It's extraordinary. Yeah. So that. I think it's had a very weird 3 or 4 years, and it's now returning to potentially that gold sort of stock that it was seen as before.
Market leading and really high defendable margins. So really good result from them. One cracking result in tag was Xero. Xero's had its doubters, I suppose, in recent times. It's been a very well performed stock, but it kicked up again on the back of these numbers, Ben.
Yeah, I think the new CEO has done a really good job at pulling away from some of the markets that they were struggling to get traction in, concentrating a bit more on a very aggressive reinvestment rate that was happening. But the big thing she committed to was meeting the Rule of 40. Now, a lot of people won't know what that is, but the Rule of 40 is if a company can achieve a sales revenue growth plus a sales margin of greater than 40%. Sorry, profit margin greater than 40%. And, there would be less than, I think, 10 companies on the ASX that have been able to achieve something like that. Yeah, so they achieved that. They actually met Rule of 41 in this result, and I think that was a big reason for the kick in the share price. I think
it ultimately should be that sort of business can be. I mean, scalable, cloud-based. Your next dollar of sales,
pricing power,
basically on a fixed cost base. So
completely.
You've got that. So it's the sort of business that can be one that meets the Rule of 40.
Yep.
Most bricks and mortar business can't do it.
No,
it's
of course
impossible.
not. Yeah.
So, but really good to see that one kick along. Another stunning result, and this is the point for people wondering, because the markets have been trading around all-time highs, just a little lower than that at the start of May, and we've pulled back in the last couple of days. But why? Earnings have been really strong. And these are the companies we're now talking about. Aristocrat.
Yeah.
I think, stunning numbers again.
Yeah. No, it was that was a solid beat. And the sugar hit was the CEO saying we're considering selling a part of the social casino business that they built up. And the analysts sort of, on quizzing him, seemed to believe that they could get anywhere between $900 million US dollars and $1.2 billion US dollars for this division. Now, bear in mind, Aristocrat already has net cash, and they've earmarked that a large chunk of this will be returned to shareholders, probably through an on-market buyback. Aristocrat bought back $1 billion of shares last year on market.
Just to reduce that cash balance almost.
It's a business that arguably should have a bit of debt,
Well, it generates so much cash.
And it's very defensive. So, you look at Aristocrat, despite the jump that it had on the result, it's trading on 17 times forward earnings, and consensus is it will grow those earnings in the mid-teens every year for the next 3 years, which would make it one of the cheapest growth stocks on our market. There's an ESG thing in there. It
For
will always.
everybody.
I think it will always look a bit cheap
Yeah.
because there'll be a lot of fundies won't be
Might
allowed
touch,
to invest in it.
exactly.
Yeah.
Let's talk banks. Let's touch on Macquarie as well as the three big four, NAB, Westpac and ANZ that reported. Macquarie's a different beast.
Yeah.
But we saw big buybacks announced from all the big four, all of them, Westpac particularly, and yet struck against an environment of little to no earnings growth.
Probably a reflection of incredibly strong balance sheets.
Yep.
I always wonder with the banks, they did the emergency capital raisings during COVID. Now they're buying back their shares at recent highs.
It's illogical in many ways, but their business model is so robust, but unexciting, that they're able to withstand that sort of level of mistake.
Yeah. Look, I think there wasn't a lot of excitement. I guess there was a bit of improvement in the net interest margins, which the market liked. And so maybe some signs that this real war for mortgages has died down. But, I think the banks have had a pretty good year this year.
Good dividends been paid out. So certainly.
But Macquarie was an interesting one because for me, Macquarie, and we both really admire Macquarie and think it's a great one. But that was the third downgrade in a row.
Yeah.
And the market has just kept looking through this cyclical downturn that we've seen in their main markets.
It's left the stock untouched. It hasn't sold it off.
No. It's been a bit surprising.
So
they do have this
story,
air trunk, that we're hearing,
data
which
centers,
is held on balance sheet
Massive.
by Macquarie, $15 billion sale price. So, there's that. And if we start to see a recovery in capital markets and the various areas,
will kick up too, and they look good. There's certainly been plenty of M&A in our market, less so globally. But lastly, we just talk to people about what time of year we're coming into. June, one of your favourite times of year. So from a financial point of view, it means a lot to a lot of investors. June 30 brings tax loss selling, so some things go on the cheap. For somebody managing super, there's a few things to consider, and you're normally across them, Ben.
This is where I normally do my joke about making sure Jeremy's taking his pension minimums. But that's the main thing. If you've got a self-managed super fund in pension phase, make sure you're taking your minimums. We're going through them all at the moment and seeing that. And then also bear in mind, are there contributions that could be made pre-June 30?
And then obviously post-June 30 is some good news coming. Tax cuts across the board in the economy.
And a kick up what you can put in your super fund next year.
$120,000 a year and $30,000 concessional. So,
right, something to look forward to.
Yep, excellent. We'll bring you another update in June, but there's some heads up on what to be talking to your TMS advisor about, and we look forward to speaking to you in June.